Hey guys, James here with Waterford Business Solutions. And staying on our topic of taxes that we've been on for the past few weeks, this week we are going to dive into K-1s. Now I'm going to spend 2 weeks talking about K-1s because I want to hit on two different primary K-1s. The K-1 for 1065s and the K-1 for 1120Ss. These are the most common that I run into and the most common that most people will run into. K-1s can come from a myriad of different places. Basically, it is a document produced by another tax return that is a pass-through or flow-through tax return. That can be from partnerships or LLCs like the K-1 1065, from S corporations or small business corporations, foreign corporations, trusts. There's multiple places that K-1s can come from. Specifically, what we're talking about today with the K-1 1065 is for tax returns produced or done for partnerships or LLCs. At the end of that return, you have to go ahead and file that 1065, but then at the end of that return, it will produce K-1s for any of the members or any of the partners in the partnership or LLC. Those K-1s then report to the partners for them to claim on their taxes any of the income share or loss share or asset share that the business incurred during that tax year that is their share. I know I said share a lot there, but that's where 1065 versus 1120S K-1s get a little funky and a lot different, and that's why we're breaking it into two different things. Now, as I said, any business that produces a profit or loss for their ownerships can claim that income or loss on personal returns if it is a partnership or LLC because they're pass-through entities. If you need more help understanding that, go read our 1065 page, watch our 1065 video, because that will be directly correlated to what we're talking about here. So make sure that you understand that. Now, with that being said, once that returns there, everything gets passed through to the partners, to the members. So any partnership, any LLC will file one. Now partnerships, that could be like an unincorporated regular partnership, limited partnerships that have some legal incorporation there, limited liability partnerships, or limited liability limited partnerships. All four of those partnerships are supposed to file a 1065, which means you're also supposed to file a K-1 so that the partners can include the profits or losses on their returns. As you're going through and doing your 1065, whether you're using a tax software, whether you're using a nationwide tax company, whether you're doing it yourself, whatever, you will have a K-1 generally created for you. But K-1s can definitely get complicated quickly, especially for 1065 filers. And we're going to go ahead and get into that. So why do K-1s get complicated for 1065 filers? Well, with a K-1, to determine your share of profits or your share of losses, you need to know where your basis in that partnership or in that LLC exists. Now, sometimes that's going to be outlined specifically in the partnership agreement. That should be outlined in the specific partnership agreement. And that is going to be your profit interest, your loss interest, and your capital interest. Make sure you know what those are and that you're quickly able to provide that, because those are three different things. With partnership interest, we've got kind of a profit interest, loss interest, capital interest. Like I said, a profit interest entitles you to future profits with the company. A loss interest entitles you to future losses, and a capital interest entitles you to net assets or anything left over at liquidation of the partnership or LLC. All of this, where you fall in, what your percentage of interest, anything like that, should be outlined in your partnership agreement, as I said. But you need to make sure you understand that so that you know whether you share in profits or whether you share in losses. The other thing you need to know, or you may not share at all if you just have a capital interest, or you may share everything equally. There's so many different little things there. Now, on top of partnership interest, we also have partnership liability, and this is also a huge thing to help determine your at-risk investment on your personal return and how much of things can kind of be related to QBI, qualified business income, based on your at-risk investment. And that's going to be your liabilities, whether it's non-recourse, qualified non-recourse, or recourse. People with non-recourse, that means that those liabilities that exist, you personally are not liable to the bank for those liabilities or for repayment. Qualified non-recourse is specifically on physical property, on real property, borrowed from the government or someone actively engaged in lending. So it's very similar to non-recourse in the fact that you're not personally liable to it, but it has to be on real property, physical property. And then recourse is going to be anything that you are personally responsible for paying. So any type of liabilities that the company has, you need to make sure you understand whether you're guaranteeing it, whether you are liable to pay anything back, what's going on there, again, to help determine your basis and your at-risk investment in the company, because all of that is going to show up on your return. Then you've got your capital accounts. If you invest money into a partnership, you're always going to have a capital account. And there's 3 different types there that, again, you need to understand how you're pricing that to understand how it's going to hit your books, how it works in your books, everything like that. Whether it's a tax basis capital account, a GAAP capital account, or a 704B capital account. All 3 of these things, partnership interest, partnership liability, and partnership capital accounts, all of those you need to know in order to fill out your K-1 for a partnership or LLC, because those go on line J, K, and L. That helps to determine your percentage of how you share in the profits, how you share in the losses, how much you can claim as QBI, and when you take capital out or when you put capital in, how it may or may not be taxed. So make sure that you know everything there, and also make sure that you understand your guaranteed income there if you're going to have a guaranteed income. With a partnership or with an LLC, you don't have to be an employee of the business like an S-Corp. But a lot of people will have a guaranteed income because they work directly or provide services directly to the partnership or the LLC. So they are guaranteed to make this much money. That also goes on there, and we need to understand where that goes, because that guaranteed income doesn't affect the profit or loss and affect your basis, because you are getting that out of the partnership no matter what. So understand everyone's guaranteed incomes, understand everyone's interest types to fill out this K-1. Now, tax softwares will walk you through this. If you're working with an accountant, which I highly suggest, at least for your first round with this, they will be able to help explain all of this a whole lot better in your situation. Obviously, I'm kind of going up and going over some of these big things. Now, the big thing to understand with guaranteed payments, going back here, is guaranteed payments are considered ordinary income for any partner that takes a guaranteed payment. That means that you're going to pay not just your income taxes to the federal or state government, but also your self-employed taxes. And all of this is reported on your K-1. You won't get a W-2 for this at the end of the year because you're not an employee. Guaranteed payments show up on your K-1 and will be subject to self-employed taxes. So understand that is going to happen in a partnership and show up on your K-1 to affect everything there. Just like your partnership, your 1065 return, K-1s are supposed to be filed by March 15th without an extension. Because these are normally filed with your 1065, and they must be filed by March so that they can be passed along to the partners, to the members, so that they can claim it on their returns. As always, guys, if you have more questions, if you need help understanding this, digging into tax returns or helping you with your tax returns, please feel free to call us, email us. You can reach us by phone at 864-351-0852 or email us at info@waterfordbusinesssolutions, and we're happy to help you guys out. Have a wonderful day, and next week we're going to talk about K-1s on an 1120S.